So you already have a property portfolio and you're ready to buy the next one to scale up. But here's the problem. You're not actually sure what your next move should be. Should you buy for growth or cash flow? Are you even in a strong enough position to buy again? In this video, I'll walk you through 10 strategic questions you need to ask before you buy your next investment. And I'll show you exactly how to answer them using SuburbsFinder's Portfolio Analyzer. Stick around till the end because the question number 10 helps you project what your portfolio could be worth in 30 years. I'm Gilbert Melgar, a data analyst, property investor, and founder of SuburbsFinder. And I help property investors make smarter, data-backed decisions every week. If you're serious about building a long-term, high-performing portfolio, hit that subscribe button. This channel is made for you. How much usable equity do I actually have? Before you even think about researching new suburbs, you gotta know your borrowing power. And that starts with equity. This is your launchpad for growth. If you don't know how much equity you can access, you risk looking at the wrong price point or overreaching financially. And here's the thing, a lot of investors think they know how much equity they have, but they haven't really factored in LVR limits, buffer zones, or bank policy. You might have a $200,000 in theoretical equity, but only $80,000 that's actually usable. That difference could completely change the type of property you can afford or even which market you invest in. Understanding this upfront helps you stay realistic and avoid wasting time looking at properties outside your financial reach. Plus, it gives you confidence when you're speaking with brokers or planning a refinance. In SuburbsFinder, once you enter the purchase price, deposit, and estimated current value, it instantly shows your estimated usable equity for each property. Is my portfolio positively or negatively geared overall? One of the biggest blind spots for property investors is not knowing how their entire portfolio is performing in terms of cash flow. You might have one great property, but two others that are dragging your numbers into red. Being positively geared means your properties are putting money in your pocket. Being negatively geared means they're costing you each year. Knowing your cash flow position helps you decide whether your next move should be focused on yield or growth. SuburbsFinder adds up your rent, interest, and costs across your whole portfolio to show your cash flow position. Do I actually want to hold each of these properties long term? Every property in your portfolio should have a purpose. Some might be short-term equity builders, others might be long-term growth plays. But if you're not clear on the role each property plays, or if you wouldn't buy that property again today, it might be time to reassess. Ask yourself, if I could sell it today with no tax or no transaction costs, would I keep it? If the answer is no, that property could be a weak link. It might be tying up equity that could be better used elsewhere. Having a clear hold or sell filter will make your next decision far more strategic, whether you're adding a new asset or considering a restructure. So we can use SuburbsFinder's Portfolio Analyzer to sort the properties by growth, yield, or cash flow. This helps us see which ones that are pulling their weight and which ones aren't contributing to our goal. So for this one, as an example, these two properties here, first property and the third property are both negative, while the fourth property is highly positively geared. So I can sort them inside SuburbsFinder. So what I'll do, I'll put this to property 1, and now property 4 becomes property 1, according to cash flow, and then next would be property 3. I'll move that here. And now I've ordered all the properties in my portfolio according to cash flow. And I can order that by according to growth as well. Which properties are dragging me down? Not all properties are equal. Some might look good when you bought them, but now they're delivering low rent, minimal growth, and negative cash flow. These are the ones that could be quietly holding your portfolio back. Spotting these lets you be more intentional with your next purchase, whether to balance out the negatives or plan for a potential sale. By knowing which ones are underperforming, you can figure out a way on how to improve them. So say for example, for these property 3 and 4, both are negative. So if there's a way that we can increase the rent, what we could do here is we can check how much other properties in the area are renting. Is there any way that we can increase the rent? And if we increase the rent by, let's say, $10 from 640 to 650, it has an effect, but not as much as we expected. On the other hand, the property number 4, we can also improve the rent. Depends on how much other exact same properties are renting within the area. The other way is, can we add more value by doing some cosmetic renovations in the property so that we can increase the rent? Am I diversified across locations and markets? Geographic diversification is one of the smartest ways to reduce risk. If all of your properties are in one area and that market takes a dip, your entire portfolio could feel it. By spreading across different states or cities, you're giving yourself insulation against localized downturns and exposure to multiple growth cycles. Plus, you're reducing the chances of getting hit hard with land tax in a single state. When too many properties are concentrated in one place, your cumulative land value can trigger a hefty land tax bills, especially in New South Wales and Victoria. SuburbsFinder makes it easy to see which state each property is in. You'll instantly spot if you're overexposed in one region. Let's have a look at this example portfolio. It has 10 properties on the portfolio. By the way, you can add as many as 15 or 20 properties in the portfolio. So let's have a look. I'll just click Analysis Report. And instantly here, we can see right away, out of the 10 properties, we can see here that the whole portfolio, 52% or equivalent to 4.8 million of the portfolio is in Queensland. And then 2 million or 22% of the portfolio is in New South Wales. 14% of the portfolio or equivalent to 1.3 million is in Tasmania. And 1.1 million or 12% of the portfolio is in Victoria. Should I buy for yield or growth next? This is where strategy comes in. If your portfolio is heavily negatively geared, your next property might need to boost your income. On the other hand, if you built enough cash flow buffer, you might want to target long-term capital growth. There's no right or wrong answer, but there is a right fit for where you are right now. Use your current portfolio numbers in SuburbsFinder to see whether your cash flow can support a lower yield, higher growth investment, or whether you need a solid 6% plus yield next. So, looking at our example portfolio, we are slightly negative. So we are negative by 1,124. That means the next property we should be looking at should focus more on capital growth, but with at least decent yield, so that when we buy that, even if we become more negative buying it, but there is more focus on the growth. So before we start simulating that, or before we add another property in our portfolio, looking at the whole portfolio or individual properties, we can uncover opportunities. So for this example, we can see that property number 4 has a slightly higher interest rate. So opportunity here is if we can refinance that and let's say get an interest rate of 6.5, and we'll look at the whole portfolio, then we are already positively geared. So that's an opportunity right away to optimize the portfolio. So now let's start adding property number 5. So click the plus icon here. So let's say our budget is 600,000, right? And let's say we're targeting at a growth rate of 6% and the vacancy rate of 2%, a rent of 600 to make it at least 5% yield, right? And then next would be interest rate of 6.5%. Now let's look at our overall portfolio. So we can see here that we are negative by almost 10,000 per year. It's not too bad. It's okay. But the good thing is, since we focus property number 5 on a high capital growth area or strategy, if and when the growth rate continues at 6%, that means after a year, the property has gone up by 36,000. So if we gained an equity of 36,000 and we lost almost 10,000 in cash flow, we still made money by 26,000. So it's still a win-win for us. So this is an opportunity on how you can optimize the whole portfolio when you run the numbers and look at individual property in your portfolio. What's my LVR across the portfolio? LVR, or loan to value ratio, is one of the most important metrics lenders use to assess risk. It tells you how leveraged you are for each property. The higher your LVR, the more risk you carry, and the less flexibility you likely have when it comes to refinancing or accessing equity. If most of your properties are sitting above 80% LVR, that might limit your options. If you got one or two sitting below 60%, those could be your equity release candidates. Understanding your LVR profile across the portfolio gives you more control when planning your next move. SuburbsFinder automatically calculates your LVR based on your input values. You can easily see how leveraged each property is and make strategic decisions. So in this case, we can see the LVR for each property. You can see here. But overall, we can see here that the pool portfolio LVR is 71.95. And the property portfolio is at 2.4 million. And the portfolio equity is 690,000. And our mortgage is 1.7 million. And the current market value of the whole portfolio is 3.6 million. The estimated capital growth of the whole portfolio is 1.2 million. And the total current equity is the sum of estimated capital growth and portfolio equity deposit. What happens if I add a new property today? This is one of the most powerful features of the Portfolio Analyzer, the ability to simulate your next purchase before you even start looking. Adding a sample property to your portfolio lets you see the effect on your overall equity, cash flow, and gearing. Why guess when you can test? It takes the emotion out of the process and gives you data-backed clarity on whether a property strengthens or weakens your position. So say, for example, we're simulating if we add another property right now. So currently we are negative 1,124, and I'll click the add new property. And then let's say we're purchasing a property. So let's say our budget was 450 and the rental income and deposit, let's say 20%. So that's 90,000. We're aiming for a yield of, let's say, 6%. So let's put this at 600. So that's 6.72. So let's put this at 575 at 6.5%. And let's say at 6.5 interest rate. So this property is negatively geared before tax. And let's see how does it affect our portfolio. So a while ago it's negative 1,000. Now it becomes negative 3,000 per year. So simulating these before we buy, we can see right away how it will affect the whole portfolio if the number of the next property we're buying is like this. So we know right away what to expect. Where can I find high yield properties in my budget? High yield properties are often the difference between a negatively geared portfolio and one that pays you to hold it. If you're cash flow negative now, the right yield property could bring balance to your strategy. But you got to filter smart, based on data, not assumptions. Using the rental yield filter inside SuburbsFinder, you can set your minimum yield, price range, even choose the state you want to invest in. This saves hours of searching and helps you focus only on suburbs that align with your current strategy. So there are two ways that you can do this in SuburbsFinder. The first way is you just put in your budget in here. So let's say your budget is maximum of 600,000 and with a yield of minimum, let's say 4.5% and above or 5% and above, and with a vacancy rate of 3% and with a compounded annual growth rate of minimum of 4%. And now you can drill down to what state do you like to invest in. And you've narrowed down right away from 15,000 suburbs, you've narrowed down to 478. And the other quickest way that you can do this is after you've run your numbers in here. So let's say we've added property number 5. We did the simulation in here. So let's say we're happy with 6.4% and our budget is 450. Vacancy rate is 3%. Instead of using these parameters and use those as a filter in here, what we can do is we can just click this search button in here, view suburbs in the dashboard, and it will automatically use those parameters and narrow down the locations for us. So when we click that, these are the parameters that we used, which was pulled from the Portfolio Analyser. And we've narrowed down the locations from 15,000 to 21 areas. This saves us a lot of time searching through areas and to different locations. What will my portfolio be worth in 5, 10, 20, or 30 years? This is where we zoom out. It's easy to get stuck thinking about the next deal, but great investors think about a long-term horizon. When you project your portfolio's value over time based on different capital growth rates, say 4, 6, or 8, you start to see what's really possible. This is how you set a financial freedom goal, plan when to exit the rat race, or decide how many properties you need. It's all about forward vision. This is where you step back and think long-term. By adjusting capital growth assumptions, you can project what your portfolio could be worth years from now. This helps with retirement planning, equity release timing, and setting your income goals. So inside the Portfolio Analyzer, so this is the sample portfolio that we have, and we'll click Analysis Report. And in here, we can see what would be the value of the portfolio in 5, 20, and 30 years' time. The blue line here shows the portfolio journey that we've been through since 2016. So in the portfolio example that we have, that's when we started to buy the first property. And it says here from 0 to 3 million in 9 years. So from 2016 to 2025, the value of portfolio now is 3.1 million. And provided that the growth rate continues for all the assumptions that we put on the Portfolio Analyzer, in the next 5 years, that 3.1 million would be 4.2 million in 2030. And in 2035, that would be 5.8 million. On 2045, which is 20 years from now, that would be 11.6. And in 30 years' time, on 2055, that 3.1 million portfolio would be 23.1 million. In an upcoming video, I'll show you how to time your equity release and use that to fund your next deposit, all within SuburbsFinder. So if you found this helpful, make sure you subscribe and hit that bell icon. If these 10 questions gave you clarity, drop a comment below with what you're focusing right now. And if you want to see a full walkthrough on how I use different supply and demand metrics to identify areas that are about to become hotspots, click this video right here. Again, this is Gilbert Melgar. See you next time.